My name is Shane Handy. I am the founder of The Rational Trader. This is a 5-part video series on trading the markets using visual order flow. Visual order flow is a way to graphically display the order flow data so that we spend less of our time picking apart the data and more time applying it to what the market is doing. Our agenda is the first video, part 1, is Introduction to Wave Volume. This is a technique we use to help us choose direction. Part 2 is an Introduction to Order Flow. This is basic concepts and a way to graphically display it so that it is easier to see what is happening. Part 3, there's a lot of ways to enter the market. We're going to look at one in particular, which is understanding breakouts. So when the market moves to a level, looking at the order flow to help us make a decision on whether we think that breakout's going to succeed or not. Part 4 is an advanced order flow view, looking at the data in a little bit different way and then displaying it differently to help us understand where is the momentum in the market. And then part 5 is bringing it all together, how I read the market using visual order flow. Now, before we get started, we need to talk about risk. So trading is risky, and you can lose all of your money. And with futures, because of the leverage, you can actually lose more than your initial investment. There's some other elements listed on screen here that are important, and I'm going to come back to them in a moment. But first, I want to talk about the nature of risk or the source of that risk. And I think this is something that people misunderstand, and as a result are focusing in the wrong area as they work to manage their risk. The first component of risk, the first source of risk is the market itself. I call this the technical risk. The market, we are trying to predict the future. That is inherently risky, and as a result, we need to deal with that. This is what most people think about when they talk about the risk in the market, dealing with the unpredictability, the probabilistic nature of trading. The problem is this is not the only source of risk, and in fact, I don't even think it's the most important component. More important is the physiological risk, or the biological component of risk. And what I'm referring to here is that when you put money at risk, your body responds to that threat in the same way it responds to every other threat. It initiates a physiological response that causes fear, anxiety, doubt, and the flip side of these, excitement, greed, and euphoria when things are going your way. This physiological response impacts your ability to make sound decisions and has to be dealt with. All right. The Rational Trader was designed to recognize that this is the largest component of risk that you need to deal with, and creates a program that is intended to help you overcome it. That's what the Rational Trader does. Now, let's go back and look at suitability, performance, and hypothetical results. Suitability is talking about do not trade with money you can't afford to lose, because you are likely to lose it until you learn how to trade. Okay? You need to start small. The other component here is that you may discover that you don't have, because of that physiological response, your trading is not for you. And if that's the case, the sooner you know that, the better. The next is performance. Two people can use the same method, the same technical method, and have vastly different results. And the reason is their physiological responses and how they deal with them as they trade. This is why person A can be successful and person B will fail, even though they're using the same thing. Okay. Hypothetical results are simulations. These do not have any element of the physiological risk at all, and are therefore useless. Just ignore them. Okay. With this in mind now, let's get started. This is part 4 of our 5-part video series on trading the markets using visual order flow. We are going to cover an advanced order flow concept now, specifically using order flow to understand what is the momentum in the market. And of particular importance are the transitions from momentum in one direction to the other, or from neutral no momentum at all to momentum in a direction. We're gonna combine this with the wave volume and order flow strength studies that we've already discussed. So if you have not watched the part 2 in particular, where we talk about the bid and ask volume, you need to stop this video and go watch that. This will make no sense at all if you haven't watched that at all that yet. Okay, so let's get started. So this is how our chart looked through part 3, where we have wave volume and the order flow strength study. So now we're going to add an order flow based momentum study, and that's what this is. The green outlines represent momentum to the high side, long momentum, and the red outlines represent momentum to the short side. Now we're going to talk specifically about how we calculate that. There's a very logical rationale for how we pick apart the order flow data and create this study. Okay, but let's just take a look at what we see here before we do that. So we've set divergence short, no interest short. We break through here. This is all momentum long up here. Okay, all of which goes nowhere because we break through. You'll notice that on this bar, the long momentum has subsided. It's now neutral. Big selling short. That's a short entry, as we discussed in part 3. The market falls through. Here you can see short momentum catching up now. It's very late, in my view. I wouldn't be entering based upon that. It's not unusual. In momentum, by definition, momentum, there has to be some movement or some time has to have gone by before you can get a signal. And so we'll see both the strength and the weakness of that as we examine this study. What happens here is we set this level. There's an attempt to go, and you can see not only the aggressive buying here, but the change in momentum. There's a very specific behavior happening here. We'll discuss that in part 5 about reading the market. But in terms of a trade setup or relative to these studies, there's nothing to do yet. We're still looking short. We're waiting to see, are we gonna continue lower? We may or may not be short off this other entry. We can see there are attempts to take it higher, aggressive buying and momentum long. Those attempts fail. You can't break through that. You switch to momentum short here, and then you tag this low, and this is where it gets interesting. You're not breaking through with any sense of continuation. There's no aggressive selling short. Even the momentum signals are not closing below this low. There, and this one in particular, the one that breaks the low closes up. All right, I call that stopped momentum. This is stopped momentum as well. Too many arrows now. This is stopped momentum as well. You can see the market, the buyers are stepping in, but the sellers absorbed it all and drove the price down. The same thing's happening here. The sellers have driven the market through the low, but there's buyers laying in wait there, and they brought the market back up. This bar closed up. Okay, the momentum has been stopped by the other side. Same thing happens here. Stopped momentum. All right, and now we get no interest long. All right, and what happens next is very interesting because we've been talking about looking at breakouts and using the order flow to help us understand what's happening. And just based on the aggressive buying, we have a signal here. But you'll notice that you also are transitioning from neutral momentum to momentum long. This makes this very strong. That's a very strong signal in my view. You'll sort of see why in a moment when we get into the specifics of how that momentum signal is created. If I was dithering, I wasn't sure what to do, that would change my mind because you've got both aggressive buying and a transition to momentum long. So you went from neutral to momentum long. You can see the buyer stepping in here. All right, and that gives this particular study quite a bit more weight. And you can see all the way through here, momentum long, it's starting to falter now, We're going to go into this consolidation. And this behavior in particular, where you're rotating back and forth between long and short, an indication that you're consolidating. And so what we're looking for here now is we need to see either a wave volume signal or a pullback. So I'm not interested in getting long right there. That's a reasonable, I can make an argument for it. Right, you've pulled back, you went momentum short, the momentum was stopped, and then it changed. So it transitioned from short to long. You can see the buyer stepping in. That's a logical thought process. The problem is that you really didn't pull back enough. All right, so we're going to talk a little bit more in part 5 about what's happening on pullbacks. Why does the market pull back? And here we don't see that. We don't see a pullback. So to me, this is not a legitimate pullback entry. Right, it's not. You don't have a good enough movement against the direction of the trend here. All right. Instead, switch back to wave volume short. I'm looking short. So really what that means is I'm waiting for the market to set this level here and then pull back. And now in here I'll be looking for, there's a very specific trade setup that I look for. It doesn't happen though. So instead I get this no interest long, right? And as a result, now I'm changing. And since I've got a strong move here, I'm looking for a pullback. That didn't happen. Here's the next attempt. The sellers still can't bring it back down, and instead I get no interest long. This is a very reasonable entry here. Right, it has to be handled a little bit differently than the ones we've been discussing because the high is right there. Okay, and this is a place of likely rejection. So there's a couple ways to handle this. You can get in as soon as that bar goes bright green, the 10 tick stop, and as soon as it closes up, move the stop to 1 tick below the bar. All right, and then, or you can wait for it to close and kind of bid back one, 28.50 in this case, 10 tick stop, and then you want to see how does it behave as it breaks through the high. If we tag the high and you close up, then I'd be moving my stop even more aggressively, 27.50, because what we're expecting is it's going to just punch through, right? You might get a vacuum pop entry, that would be fine, but it should not, by definition, it won't close, it won't tag this 27.50 level, all right? It won't go below the low of this bar. So these are reasonable entries here based upon what we've seen. The market, it advanced hard. We didn't get much of a pullback, so nothing to do there. We show divergence short. We switch to momentum long, and so we're looking for the long. You can get in early here, actually, before that break. You can see it breaks cleanly. A vacuum pop entry on the next bar would be reasonable, like right there. That's a little late, actually. It's still good. You can do it. I would categorize it as a little bit riskier, but basically, once you break through, you're looking for the next bar or the bar after that. The first or second bar after the break is a candidate for one of these vacuum entries. All right, I like them closer, but that's just because I'm worried about chasing. Okay, let's go and look now at exactly how this is being calculated. All right, and then we're going to use this for a more nuanced read of the market and how it is behaving. So to understand how we're calculating this order flow based momentum, let's take a look at the volume at price chart. As a reminder, we're looking at a chart this is using a built-in study to Sierra chart called numbers bars, and what it's showing us is the number of contracts that went off at the bid price and the number of contracts that went off at the ask price on each side of each of these bars. All right, and what we want to do, and again, trades that go off at the ask, that's aggressive buying. Trades that go off at the bid, that's aggressive selling. And so at the bottom here, we have this another built-in Sierra chart study called numbers bar calculated values, which is showing us, is just adding these up for us. All right, 678 buys, 715 sells in this bar, or rather aggressive buys and aggressive sells, I should say. There is an additional line on here called ask volume minus bid volume, and that's exactly what you think it is. That is the difference between the two. All right, so you take the ask volume and you subtract from it the bid volume, and you get the delta. All right, and we're going to use this in a moment to help us understand the relationship between the buying and selling over time. All right, so one thing to remember now, keep in mind, this chart is a range bar chart. There's no concept of time in it. You don't get a new bar until you finish trading in the 10 tick range of the bar, all right, and then you start a new bar. All right, so this bar could take 1 second, it could take 20 minutes. It doesn't matter to this chart how long it takes. It only cares about the range. But what we want to do, and so this, our other order flow study is using the range bar chart. All right, this is, I see aggressive selling in this bar. All right, what we want to do is we want to take a time-based view and add it to this chart. So we're getting sort of the best of both worlds. We get a very clean view of price from the range bar, but we can also get a sense for what's happening over time by applying a time-based study to it. And so what we're going to do is we're going to take the same symbol, NQU7 in this case, and we're going to create a 15-second chart, 15 seconds. Okay, it's very fast. You're going to get 1 bar every 15 seconds, 4 bars per minute. All right, and we're doing this because we want to be very responsive to changes in the momentum in the market. All right, so the graph here is just showing the price as the market trades, and we're getting a new bar every 15 seconds. What we want to do is we want to take this numbers bar calculated values study and display it. And what it's going to give us down here is the ask volume and the bid volume plus the difference in each bar. Now we're only going to use the difference. Okay, what I care about for this study is the delta between the buying and selling. All right, who in each particular bar, which side is winning? All right, which side is being more aggressive? All right, and what we're going to do specifically is we're going to plot this. We're going to plot the difference. That's another built-in study to Sierra chart. So this is a good time to point out that Sierra chart is incredibly powerful in the ways that it gives us tools to work with. So here we're going to take a study called bid volume versus ask volume. We're going to display that, and what it's going to do here is show us, let me make it a little bit bigger. It's going to show us the difference between the buying and the selling. It's going to plot as a bar this blue line here, this ask V minus bid V line. We're going to plot as a bar. So here you can see 439 buys in this bar. This bar is really big. All right, and what I'm going to do now is turn off the study below, just so we have a little bit more screen real estate to work with. All right, so what we have here is the bid-ask difference being plotted in a bar form for each bar. Okay, so you can see, there's spikes here and here. In general, some spikes here on the buy side, spike here on the sell side. And what we want to do is, we're not interested so much in how it's behaving in a single bar, but we're interested in how it's behaving over time. And so we're going to apply a moving average to this value, to the difference value. All right, and so to do that, we've got just an exponential moving average. If you're curious about the settings, it's based upon the bid volume versus ask volume difference. We're looking back 15 bars, so it'll be 3 minutes and 45 seconds, so just under 4 minutes. And let's unhide that. And that's going to give us this cyan blue moving average here. And I need to make this a little bit bigger here so that we can see it better. All right, so what we have now is we have the bid-ask difference being plotted. And I've zoomed in on it so that we can see it a little bit better. All right, so each of these yellow bars represents positive net aggressive buying or negative net aggressive selling. All right, as the market trades. And then there's a moving average. This is the cyan line right here, and this is plotting the moving average of the difference. Okay, so we're not looking at the average of the buying or the average of the selling like we were doing with the order flow strength study. Instead, we're looking at the difference between the buying and the selling. Okay, so who's winning basically. And we're looking at that over a course of the last 3 to 4 minutes. Okay. And what we want to see is if the average amount of buying or selling exceeds a certain threshold, then we consider that momentum. All right. And this is what you see here. This green line and red line represent the threshold at which, if the moving average crosses that threshold, we consider that momentum in that direction. Okay. So if you look here, this is 6:30 here when the market opens, right here. You can see we're crossing above. This is momentum long. We stay above all through here. Still very clearly, buyers are winning. There's much more net buying than there is selling, or net aggressive buying, I should say. All right, and then finally, here is where we cross through. And in fact, all in one space, we very dramatically fall off here. There was a lot of selling in this bar right here, and right here it goes momentum short on this bar right here. This is 635.15. All right, we're going to go mark that on the other chart in just a moment. All right, but the point here is it's actually a very abrupt transition where you go from, you've been momentum long for quite some time, and in the next bar you go momentum short. All right, we then stay momentum short for a while. All right, not too long actually, before there's enough buying. See here, the net buying here is enough to pull it back up, and in fact you cross the this green line right here, so that you see net buying now. All right, and then you're kind of trading back and forth above before you fall through again. Okay, so every time we're crossing the green line, the green dashed line to the high side, or the red dashed line to the low side, the momentum is reversing from long to short and short to long. If it's in between here, then it's just neutral, like right here. The momentum's neutral at this point. Okay, so looking at the difference between the buying and the selling. So take the net aggressive buying, the trades that went off at the ask, subtract from that the aggressive selling, the trades that went off at the bid. So ask volume minus bid volume, that's a number. If that number is positive, then the buyers are being more aggressive. If that number is negative, then the sellers are being more aggressive in that particular 15-second bar. We look at the last 15 of those bars to get a sense for what's happening over the last few minutes, and that gives us a momentum signal based upon the order flow. Okay, and so if we come back to here, what we see is the market opens up and you've got momentum long. You're seeing more net aggressive buying than you are aggressive selling, but it changes, and it changes very dramatically. All right, now we have to talk a little bit about the differences between real time and a historical chart. In the historical chart, we see the momentum go red here. Okay, but in real time, that's not what happens. In real time, it's this bar that goes bright red. And the reason is that these bars all drew in under a minute. And the way the software works, unfortunately, in a historical chart, we're only going to get an outline on the ending bar, the bar where the minute ended, basically. And so it's something you have to be aware of, that it does look different in real time versus after the fact. In this particular case, while this is drawing in real time, you're at the right edge of the screen, that bar went bright red. And it stayed bright red. This one went bright red. And so the signal is actually much stronger to short than even just the pink bar here. It's similar to this one, just in the opposite direction, where it is bright red in real time. And you can tell that by looking at the time of when we crossed here. Let me get rid of all these other lines. All right, so we crossed here. All right, and that bar is drawing at 635.15. All right, and so you look to here, you can see this bar started drawing at 635.21. So it's already gone bright red. All right, and these actually are drawing so quickly that in the historical after the fact chart, we only see that signal on this last bar. So something to keep in mind. If you're looking at it after the fact, And it kind of looks like, gosh, I really would expect momentum to be there. Go check. You can go check and see if it was there or not. Okay, so what we see then is momentum short on this break. Not surprising. This here, you can see the buyers are stepping in here. Now, we're going to talk a little bit more in the next part about really what's happening here. All right, because there's really sort of two kinds of buyers and sellers. If you look at the buyers, some people are buying because they've been short and now they're getting out. Others are buying and they're new buyers entering the market. Same thing for sellers. Sellers can be selling because they're closing out their positions, or they can be selling because they are entering a new short. And so we need to make a distinction between those two to the extent that we can, and we're going to talk about that more in part 5. For this exercise, what we have now is, in addition to our wave volume and our indication of buying or selling strength in the range bar, we now have a time-based view of the momentum based upon the order flow. All right, so let's review that real quick, and then we'll wrap this video up. We're looking at the difference between the buying and selling on a very fast time-based chart, a 15-second chart. The net trades that went off at the ask minus the net trades that went off, or rather the trades that went off at the ask minus the trades that went off at the bid. That gives you a number. If that number is positive, it means that there were more aggressive buyers than sellers. If it was negative, there were more aggressive sellers. We then plot that here on this 15-second chart using the bid volume versus ask volume study, and then we apply a moving average so we can see how it looks, not on every bar. That's too fast. What we need to see is over the last few minutes what's going on, because we're looking for momentum. Okay, and so we apply a 15-period moving average, and that gives us a sense for what is the trend of the behavior in the market. Are we seeing more aggressive buying, or are we seeing more aggressive selling? And I specifically use a level here where if the moving average crosses that level, that's a threshold for me to say, yes, I see long momentum in the market or short momentum. Okay, this threshold for the NQ is 15 and plus 15 and minus 15. That has to be tuned per market, by the way. All right, and so when we see the market change from either neutral to momentum short or momentum long to momentum short, that's a visual cue that we get that there's been a change in who's in control of the market. All right, and so if we add that to the context of the direction that we're looking and sort of where we are at that point in time, it can help us make a decision on whether or not we want to enter. All right, so that's it for part 4 of this video series. In the next series, the final part 5, we're going to talk about how to put these building blocks we've created together to actually read the market. Now, you've gotten a sense for a little bit of it through some of these individual videos in the series, but now we're going to put it all together, and we're going to start from the beginning and say, okay, I'm going to read the market. What is it doing? What do I think it's doing? And we're going to use that to help us make a decision on specifically which direction to go and when and how to enter.